Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. But today is another episode of my $100,000 portfolio series where I'm trying to build a $100,000 stock portfolio in this platform, M1 Finance. If you guys want to check out the first episode of this series and a detailed breakdown of M1 Finance as a platform, definitely check out the video. I'll go ahead and link it above. That actually started off this series. I put new episodes of this series out every month on the 15th. So you'll see my progress towards building that $100,000 portfolio and any moves I might have made in the portfolio in the meantime. But this month I've actually made some pretty sizable moves. The first being getting rid of the BWC index, which I'll go over in a second, adding this clicks share here, and then also adding my newest, one of my larger positions is CVS, the health pharmaceutical retailer. And I'll definitely get into the valuation of what I think CVS is probably worth and why I decided to make the play. So I'll go ahead and actually go through how I actually calculated that intrinsic value of the stock, at least what I think it is, in this video. So definitely stay tuned for that. But first, as I mentioned, I want to go over the BWC index, which I got rid of. That was this pie right here. Now, this was mostly made up of some large tech stocks like Facebook and Apple, but mostly larger retailers, and they had appreciated very handsomely since the crash, and I think most of them are very overvalued, and I thought I'd rather just take the profits now, pay taxes on it, and then roll it over into something else, because I really don't like where a lot of valuations are right now for some of these companies, really most of these companies. And retail long term, especially brick and mortar retail, I think is a fairly dangerous game for the long run. Not that there's not going to be some winners, but as a sector, it's very hard to do well. And I'm a little nervous given the state of the pandemic, the state of the economy, that retail is probably going to struggle for the most part, and will continue to struggle, which is why I actually ended up adding this other holding right here, Clicks, the ProShares Long Online Short Stores ETF, which tries to mimic this trend of retailers increasingly moving to online and e-commerce at the expense of brick and mortar retail. And that too has done very well over the last few years, and I think will continue to do well over the long term. Now I'm actually going to show you what's in this ETF so it makes a bit more sense for as how they're doing it. So this is on the ProShares website. Again, the ticker symbol is CLIX, C-L-I-X. And you can see it's done very well over the past few years, and that's not a surprise given the performance of e-commerce and the performance of brick and mortar. So here's the main holdings in this ETF. You can see it has a long portion in that they're hoping for these things to go up, and then a short portion where they want these things to go down. So the long position has a plurality share in Amazon, and that I already have that in my portfolio. I think it's the leading e-commerce site in the world. Not that there aren't other big ones like eBay also in this fund, but you can see this is all online retailers. And yes, Amazon does have some brick and mortar that they're moving into, like with grocery stores, Whole Foods and all that sort of stuff. But you can see mostly it's exclusively online retailers, Wayfair, Groupon, Overstock.com, all these mostly big e-commerce chains. So as long as e-commerce keeps growing, we would expect this portion of the portfolio to keep growing as well, and I think it probably will. Now on the short side, here's the opposite. We have retailers that are almost exclusively, or at least predominantly, brick and mortar focused. Not that they don't have online sales, pretty much every retailer has online sales as well, but they're really brick and mortar focused. So you have companies like Macy's, Lowe's, AutoZone, Dollar General. So it's mostly brick and mortar stores and very big chains as well. And some of these I'm sure will do well. So these shorts aren't all necessarily great, but a lot of them, I think this will serve as a great hedge against declining brick and mortar retail. And that's the reason I went ahead and opened this up while closing out my BWC index share holdings. And just so you understand how a short works, in case you're unfamiliar, basically what happens is the fund will go ahead and borrow shares from a brokerage, and then it sells those shares immediately. So it basically has a debt that it has to repay at some point. If the share prices go down, then they can rebuy the shares at a cheaper price and then sell them back to the brokerage, and they keep the difference. Whereas if they go up in price, now they have to buy the shares at a higher price to give them back to the brokerage. So you don't want it to go up when you have a short position. And technically there's unlimited risk potential with a short, since it could technically go up to infinity. I would assume that wouldn't happen, but it could happen. Now, this ETF does have a pretty large cash holding as well to hedge against that. You wouldn't want just all shorts and no cash off to the side in case that happens. So it should be pretty well hedged against that risk. Plus, it also has all of these online companies that have been doing really well and probably will continue to do well, and they could at least keep up, I would think, with any brick and mortar retailers that also would go up at the same time. Now, another sizable change I actually made is in this Ben Felix Balanced portfolio slice right here. I actually added an international stock allocation as well, and I sold off some of each of the total stock market, small cap, and value index funds that are all they're all US funds, and I think the US stock market is a little out of control right now, and I wanted to get some more exposure to international stocks. I do have it elsewhere in my portfolio beyond M1 Finance. I do have some more international exposure, but probably not enough given how expensive the US market is right now. So I went ahead and did that to hedge a bit against the US and have some more holdings outside of the US. And if you guys want to see all of the holdings in my portfolio, go ahead and check out the link in the description below. If you open up a free account with M1 Finance using my affiliate link, and then you can actually copy this portfolio and take a look at all of the holdings within it. And if you want to use it, you can actually adjust all the holdings as you see fit, or keep it if you like it. There's lots of different things you can do with this platform to customize your exact portfolio allocation as you'd like to have it, based on your risk preference, based on your investment time horizon. Lots of great things that you can do to change your portfolio so it fits your financial needs. I'm not a financial advisor, so these aren't stock recommendations or anything like that. Your situation is your own. Definitely do your own research. This is hopefully just a way for you to get some different perspective on investing. So that's that new holding. So let's go ahead and get into the big play that I want to talk about right now, and that's CVS. CVS, for those of you who don't know, is a large pharmaceutical retailer, or a pharmacy is really the real word I should be using, and they have actually been doing quite well over the past few years and have seen pretty nice free cash flow growth. I'm going to get into the numbers in just a second, but first I want to talk about value investing itself. Value investing is where you try to buy a stock at lower than what you think its intrinsic value is. Technically, all investing is some form of value investing. You're not going to buy something if you think it's overpriced, at least one would think. So value investing as a school of thought tries to take that a little bit further, in that you're really trying to get a smoking deal on a stock when you buy it. It's really the epitome of buy low, sell high when it comes to value investing. Now, there are a lot of value investors out there. Warren Buffett, very famous value investor. Benjamin Graham is kind of the father of value investing. He wrote The Intelligent Investor, that very famous book that so many stock people are so into, including Warren Buffett, who was his mentee. But there's others out there, Monish Pabrai, Phil Town, a lot of smaller guys, in addition to larger investors as well, that consider themselves value investors, at least on the passive side. Now, if you guys want to learn more about value investing and that school of thought, definitely check out Investing with Tom. He's another YouTuber. I actually had him on my podcast a couple months back. Definitely check out that episode. I'll go ahead and link it above. He talks about value investing and how he finds stocks and how he values stocks. And a lot of the channel material that he has goes into actually analyzing different companies and how he would value them, and also going over what big investors are doing, especially investors like Warren Buffett and Phil Town, like I mentioned earlier. But I'm actually going to show you how I did a quick valuation for CVS using a tool that Investing with Tom has shared on his channel before, and that's this calculator right here. It's an Excel sheet that uses a discounted cash flow model. And a discounted cash flow basically means that you're discounting future cash flows at your required return, or the discount rate in this case. So in this example, using this spreadsheet that Investing with Tom has on his channel that I went ahead and downloaded, and you can actually download it for yourself as well if you head on over to his channel and check out some of his videos. It's a really easy tool for quickly evaluating stocks, so I thought I'd show it off on this channel to help Tom out, since he's a great guy. So you can see we need a few things here. There's two different ways to evaluate using this spreadsheet. So Tom has his own discounted cash flow, and then this other one is based off Monish Pabrai, who's another famous value investor that I mentioned earlier, and they're both valid ways for figuring out the valuation of a company. However, Monish Pabrai's focuses more on market cap, whereas Tom's focuses on enterprise value, which takes more debt into the equation, and I'll get into that as well. So let's go ahead and punch in the numbers here for CVS to see what's going on with them. So first, you got to find the projected growth rate for CVS. Now, this can be totally up to you, but just for the sake of simplicity, let's go ahead and head on over to Yahoo, and here is their growth rate that they're projecting for the next 5 years. And this is what analysts are saying. This is what CVS is probably saying as well for as to what they think their growth is going to be for the next 10 years. Obviously, you're predicting the future here, so you never know what's actually going to happen. But let's use this as a benchmark. So we'll say 6% and 10% for our growth rates. So 6% in the first 5 years, 10% in the next. Now, how much free cash flow do they have? So we can go on over to Yahoo Finance as well. No, wrong tab. Here it is. So this is just off their balance sheet. You can quickly calculate this based on the amount of money coming in versus amount of money coming out. Free cash flow is the lifeblood of a business. This is your real profit because this is what turns into dividends or what's reinvested into the company to grow it. And those are both great things for investors. And you can see their free cash flow has grown very strongly over the past year. You can see in the trailing 12 months, we're at 13 billion. And yes, I'm reading that correctly. All numbers are in thousands, and this is a million number. So 13 billion right here. And last year they were at about 10. They have had a bit of a spike in the pandemic, given the demand for lots of different things like masks and also the potential for getting a vaccine deal. So there might be a little bit of short-term influx here, but otherwise they have been growing pretty strongly over the past few years. Now, they do have a lot of debt, which I'll get to, but the free cash flow does look really good. So I'm going to go ahead and use 10 billion. I'm going to use last year's numbers rather than this year's more favorable 13. But if you wanted to use 13 because you think it's going to maintain that, that's a great thing to do too if you're more bullish on CVS. So I'm going to go ahead and put 10 right here. Now we need to figure out how much cash they have. So let's go back to Yahoo and figure out where their cash is. So they have about 17 billion in cash. They basically have a bit over a year's worth of free cash flow sitting on the sidelines right now. So let's put that in there as well. So they have about 17 billion in cash. So based on this discounted cash flow model, we're looking at about a $193 billion market cap. However, the current market cap as of today is about 75 or 76 billion. So that would make you seem like, wow, this is a smoking deal. You better buy CVS if you know anything about stocks. This is an amazing valuation, but it doesn't take into account debt very well. So let's go ahead and head on over to enterprise value because this is a very optimistic calculation on the market cap of CVS if you're looking for a sort of intrinsic value based on their future growth potential. So now let's head over to the other version of this calculator on Tom's side, the edited version that Tom did. So same thing with the growth rate. We'll do 6 and 10%. And then we know it's 10% free cash flow, or 10 billion free cash flow, that is. So let's see here. If we just did that, we'd have a current approximate enterprise value of 175 billion. And right now, the enterprise value is at about 150 billion. For those of you who don't know, enterprise value takes the total equity plus the total debt minus cash. So right now, CVS has about 92 billion in debt. So it's kind of a lot of debt, considering how much they're making. But they are making about 10 to 15 billion per year right now. So they could pay down a good chunk of it. They do have about 17 billion in cash as well. So they're not in a terrible position. I wouldn't call them over leveraged in my opinion, but you know, there's a good bit of debt there and you have to factor that in. And now suddenly it looks a lot less ridiculous on the valuation compared to the other one. So right now it still looks like it's undervalued. So if you wanted a 10% return, assuming the current growth projections, this doesn't look like a half bad deal. It has a 3.4% dividend yield right now, so you get a dividend there, and only about a 17% payout ratio as well. So they have plenty of room to keep paying out a dividend. So that's really great. Here, let me actually just double check that dividend payout. Sorry, payout's at about 28%, not 17%. The dividend growth has been about 17%. That's where I got that number from. So right now, they're only paying about a quarter of their cash flow out as dividends. So they still have plenty of cash to use, so it's not like that dividend's super threatened right now. Not that they couldn't cut it anyways, but it doesn't look like they would given how much cash they're raking in right now. And you can see that on this graph here, that their free cash flow, this blue line, has grown a bunch over the past few years. And traditionally, the CVS stock, which is this purple line right here, has followed mostly that cash flow growth and decline if there's been any. And all of a sudden you have this divergence here. And it's very odd that it hasn't followed it up as this cash flow has grown so much. So it seems like a weird sort of glitch in the market, unless there's just some information that I'm missing, which I could be, or just people really don't like CVS for some reason. Because the numbers would suggest that this is undervalued right now. I ended up buying about $400. It was like 8 shares or something like that. Now I'm actually waiting to buy more, as I think it's probably going to go down a little bit more, as it looks like the market's starting to deflate a little bit, and I would hope you can get it for a much more sizable discount so I could get a better value deal on this stock. But for now, I've opened up a position in it, and I think it'll do decent in the intermediate to long term, I would think. Because if I go ahead and lower the growth projections down to say 6% rather than 10, I do 5% or something like that. So if they're well under their growth projections for the next decade, they're still at about their current valuation. So that seems like a decent deal to me, and that's assuming you want a 10% return each year. So I like CVS as a stock play. I'm not a financial advisor by any means, but it does seem like a decent one just by doing a simple discounted cash flow analysis, because they are throwing off the cash right now. So I bought into CVS at about $57 a share, and that's about where it is right now in its price. If it drops down to the low 50s, I'll probably buy more, and if it drops down into the 40s, I'm probably going to buy a ton. So we'll see what happens over the next few months or few weeks. Meanwhile, everything else in the market still is doing quite great, even though we had a little bit of a deflation in tech, since that seems to be a bit of a bubble right now, and I do have a lot of tech here in the New World Order section of the pie of Tesla, Amazon, Google, Facebook, all the big names, and they've done obviously tremendously over the past few months. So I actually sold off about like $100 of Tesla just to put it somewhere else, because I can't justify that valuation, and I wanted to take some of those profits. So we'll see what happens with my whole portfolio. I'll be giving you updates regardless each month on the 15th, so be sure to subscribe so you don't miss any of those updates. But otherwise, if you guys have any questions about my portfolio, my strategy, or if you have any comments about it, definitely let me know in the comments below. And definitely give this video a like, since it helps the channel out a lot and more people can be exposed to this sort of content about investing and also about this platform, M1 Finance. Again, you can check out my affiliate link in the description below if you want to open up an account with them, and definitely check them out because they are free after all, so might as well take a look. But until next time, take care.